Welcome back to the Legacy Radio Network. This is Everything Financial Radio. I am your host, Dennis Tubergen. Our guest expert on today's program is Mr. Jeff Kennedy, who is Chief Commodity Analyst at Elliott Wave International. And, Jeff, prior to the break, we were talking about your take on the economy and your take on the future direction of stocks. And you are expecting, based on your analysis, that we will see a market decline at some point, not unlike what we saw in 2007 and 2008. Are you willing to go out on a limb and give us, in your opinion, what the depth of that decline might be?
Oh, sure. I don't think it's really much of a limb at all. I will say the only caveat I guess I would throw out is I'm looking for kind of a stair step, or as an Elliottician, we think in waves. Waves 1, wave 2, wave 3, wave 4. We think in waves. So I would probably just go ahead and say my first wave down that I'm anticipating in the market. For those of you who are familiar with, say, Dow numbers, I'm looking for a move down to, say, 9,000 or 8,500 on the Dow. If we're looking at, say, the S&P cash market, then I think a realistic number for where my primary attention will be focused initially on, say, 950 on the S&P cash. So those would be, like, I guess my first focus. If I'm here in Georgia, and if I'm going to say drive to New York, my first major city I hit going north is going to be Charlotte. So once I get to Charlotte, or Charlotte, North Carolina, then I can reevaluate. So when I'm looking at the price charts, say for the S&P 500, my first big city down is going to be 950. So that's where I'm initially looking to go, and that would roughly equate to about 9,000 or 8,500 on the Dow Jones.
So, Jeff, that's a little bit north of 30%, just doing some rough numbers. The Dow has been hovering around 14,000, so to get it to 9,000, we're looking at 35, 40% maybe on the downside.
Yeah, that'll be the first stop. And once we get there, I'll step back, reevaluate, and go from there. But that's my outlook. I think we're going to be trading that by year's end.
And Jeff, give us your outlook then for bonds. Certainly the Federal Reserve has been tinkering in the bond market, to say the least. They've been buying up a lot of government debt. We've seen massive deficits projected for as far as the eye can see. When you look at U.S. government debt from a technical analyst perspective, what do you see?
Well, Dennis, I hate to do this to you, but I'm just going to have to say I don't know. It's been so long since I looked at a bond chart. I don't have a confident opinion either way. I spend most of my time looking at commodities, individual stocks, and the S&P and the Dow Jones. As far as the bond market goes, I don't have a confident opinion. Simply because I don't look at bond charts much anymore. I'm primarily currencies and everything else, and so I don't want to fudge an answer or try and make one up on the fly.
You know what? That's great, because I'm going to move to the next question. And a wise man once told me that smart people know what they don't know, so I appreciate that very much.
We'll go with that. I have no opinion on bonds because I haven't looked at a bond chart in a long time.
Let's go to currencies since you mentioned that. Along the same lines, we're seeing quantitative easing, from here to infinity. It seems to be the Federal Reserve's policy. When you look at the U.S. dollar from a technical perspective, what do you see?
I'm actually bullish on the U.S. dollar. I've been following wave patterns there quite closely, and everybody understands why. Since I look at the commodity markets, you got to keep an eye on what's going on in the currency, certainly in the dollar, because they have an inverse correlation. If the dollar strengthens, you tend to see commodity weakness and vice versa. Bottom line, I like the upside in the dollar. We appear to have hit a floor in the cash market, roughly around the 79 handle. I actually think we're going to begin turning up from here, and I'm bullish of the dollar. I like the upside. I think we're going to be moving back above the highs that we saw back in 2012, which were around 84.10. So I like the upside there. And if any of your listeners agree or are curious, one play you may want to take a look at if you don't want to play the actual futures markets is ticker symbol is UUP for the ETF that does follow the dollar index.
Jeff, and maybe this isn't a fair question, so if not, I have plenty. But when you look at the monetary policy of the United States, one of the biggest fears that people have when I speak at a seminar, when they attend one of our discovery groups, is that I'm seeing money printing, which is leading to inflation at the gas station and the grocery store. At least that's the perception. So how do you square being bullish on the dollar with current monetary policy? Or doesn't a technician do that?
Well, technicians tend not to do that, but also, two things, actually. Many times whenever we look at a price chart, we see a move coming, or we see a high probability outcome. And many times what will happen is we don't know how we're going to get there or how that outcome is going to be arrived at, but we know that outcome is going to happen. And that happened to me, I remember, years ago when I was doing some analysis on the Indian rupee. I made a kind of a crazy market call at the time, extremely bullish, and I asked a number of my colleagues, does this make sense? And every one of them said, no, absolutely not. Well, about a year later, the forecast I had was came to fruition. So with respect to what you're saying right now, I think we're going to have to turn to, or my answer would be, or a logical solution would be, Europe. Okay? Whenever I say that I expect the dollar to rally, I do expect the dollar to rally, and I expect the dollar to rally back above the highs we saw in 2012. I think it's going to be prompted not because the dollar is healthy, not because the United States is practicing sound monetary policy, which we're not. But I think problems in other countries, primarily Europe, is going to drive a lot of investors into the dollar. So let's just say this. The dollar is the prettiest horse at the glue factory. And I think that is what's going to cause the dollar to move up. Not because I think we're probably like the, the prettiest horse at the glue factory, pretty much. I think that's what's going to cause the dollar strength.
So, Jeff, let's talk about commodities, because when one thinks about commodities, you think about maybe metals, copper, building materials, that type of thing. So give us your take on the direction of some of the commodities markets moving ahead.
Okay. Gold. I like the upside in gold just for the short term. Say maybe the next 6 to 18 months. I think that market stands a good run on maybe 2,100. But then thereafter, I'm not that bullish on gold, primarily because you have a in commodities we tend to see about a 30-year cycle top to top and 30-year cycle from low to low. The up legs, the advances tend to last about 10 years, and the declines last about 20 years. So if you look at a gold chart, you'll see prices bottomed out pretty much around 2,000 in gold, and climbed nicely into about 2010. Well, we don't have much more upside when we're kind of beyond our little cycle window. I do like the idea, again, of maybe a run on some higher prices in gold, but I think bigger picture, the pressure is actually on the downside. So I'd be very watch this shelf of support in the gold market around, say, 1,600 through 15.5. That area, I think, is very, very important. So as long as that shelf of support, again, 1,600 to about 15.5, I like the upside for one more final last hurrah in the gold market, and then I think that's going to change. Energy markets, I kind of like the idea that we're going to see lower prices in crude, higher prices in natural gas. Natural gas, I think, historically is trading at some all-time lows, or at least in, say, if you look at the history of natural gas trading over the last 20 years, we're in the bottom 10% of that 20-year range, so I like the upside in natural gas. I'm not saying go out and buy natural gas tomorrow. It doesn't work that way. I'm saying the trend I see over the next 1, 2, and 3 years will be to the buy side, will be bullish. An ETF I like to follow whenever I play natural gas is UNG. Ticker symbol is UNG. The grain markets and I guess your foodstuffs, your coffee, cocoa, sugar, cotton, the grains, and the meat complex, I'm looking lower in those markets, actually. I think, again, this is where you're going to really see that dollar strength have a negative impact on those markets. And really for the last, say, 3 to 6 months, in many of the commodity markets I've been following, we have seen significant declines. We've seen, say, since that final quarter of 2012, September, October window, we've seen, say, soybean prices, fall fairly hard. We've seen wheat prices come down, corn prices come down. Coffee, cocoa, some of your softs, we've been in major downtrends for years now, since maybe 2011 in some of these markets. So I'm continuing to look for really lower prices across the board, lower commodity prices.
Well, and certainly if your view is that you're bullish on the dollar, then it would seem like that would be bearish for just about anything priced in U.S. dollars because as the world reserve currency, I think just about every commodity at this point is priced in U.S. dollars. So as you stated, that could be good news for people going to the grocery store and buying food over the next couple of years.
And as a country, we really don't like it when people want to think about changing that, just by the way. But as a side note, never mind.
All right. Well, Jeff, we've got a couple minutes left, and I have one more question for you. We do have some of our listeners that are traders. They do invest in themselves. What is really the key to managing risk in this, as you said, at least indirectly, fairly risky environment?
Mm-hmm. Oh, wow. Well, it depends on the situation. If we're looking at, say, an individual who's managing their own personal net worth, then you really shouldn't risk more than anything that you're willing to lose. And I think that's going to certainly be dependent or case dependent depending on the situation. For example, my father is in his twilight years, pushing 80 now. I've recommended for him to be totally out of the market. He simply has no business being in the market. At his age, that's simply my advice to him. For someone who's younger, maybe in their 40s or 50s, I think there's definitely a place. You need to be in the market, and not just the market, but you need to be looking at many different opportunities. Invest in yourself, invest in real estate, start a business, many different things. But managing risk is simply, I think, being smart and preparing for adversity. For example, we'll just say, 1 to 5, risk reward. Okay, why? Well, you've got 4 tires on your car. How many spares do you have in the trunk? 4 or 1? Okay, well, you have 1 spare. I think moving forward, and as far as managing a portfolio, just simply being smart and practicing good money management principles is the way to go. Most of your professional money managers say don't risk more than 2 to 3% in any given position. Maybe 5% if they're risky, or if they're ultra conservative, maybe only 1%. These are numbers that Wall Street's been utilizing for years, and with good reason why. Because they're all designed to keep you alive, keep you in the game. Because most of your Wall Street traders understand that even if they have a bad quarter or a bad year, if they still have their capital to work with, then they still have a seat at the table, and odds favor that they'll make it back. But if you go all in and you're wrong, well, you're out of the game, and you can't come back.
Jeff, we're going to leave it there. We appreciate you joining us today. Everything Financial Radio will return after these words. Stay with us.
Dennis, thank you.